Hi everyone. This is Financial Management, FINA 2316, and we are now starting Chapter 2, Accounting and Financial Statements. The first thing we're going to talk about is the difference between bookkeeping and accounting and the steps in the accounting cycle. When it comes to the accounting cycle, when you're talking about the day-to-day journal entries or analyzing transactions, creating your journal entries, posting your entries into your ledgers, and preparing the unadjusted trial balance, that is the bookkeeping aspect. Now, sometimes adjustments are also done by the bookkeepers or the accounting clerks in the organization, but a lot of times those are actually done by the accountant. Um, Once the adjustments are completed, and that would be things like adjusting inventory, recording depreciation, and such adjustments like that. Once that's done, then the adjusted trial balance is completed. Then once the adjusted trial balance, which is still the responsibility of the bookkeeping aspects, once that's completed, then we move on to the actual preparation of the financial statements. And as I'm sure everybody is aware, basically in most organizations, and I'd say probably at least 95% of organizations, this is all done electronically, that financial statements can actually be printed off from your accounting program at any moment in time. Um, but they can also be analyzed at the end of each month. And that's when the financial statements would be printed off either by the accountant or the bookkeeper, and a complete analysis would be done of these financial statements. This is definitely part of the accounting role in an organization. And then also these financial statements are used for the actual decision making within an organization as well. So what we're talking about here, and some of these slides I find a little bit confusing. There's actually a chart in the book, figure 2-3 on page 45, that talks about all four financial statements and clearly states what's included in each of them. For example, the statement of financial position that you can see on your screen right now, that includes your assets, whether it's current assets or long-term assets, or also referred to as non-current assets. And then on the right-hand side is your liabilities, current and non-current liabilities, as well as the owner's equity. The statement of financial position, as you can see by the classification of accounts that are on there, is what is also referred to as your balance sheet. Your statement of income accounts, as you can see, includes your revenue and your expenses. And this can be referred to as your statement of income or your statement of comprehensive income. And this, of course, is your income statement. Comprehensive income, or when it includes comprehensive income, that is just when there's other income earned by the company that's not, that it doesn't come from day-to-day operations. That would be things like currency exchanges, or if they were able to make a gain on the sale of an asset. So things that aren't part of the day-to-day operation. Okay, so don't worry too much about comprehensive income. We're not really going to be getting into it in this chapter, or actually even in this course. So it's more the statement of income and focusing on what's included in the day-to-day operations of your company, what you sell, what you buy, and what your regular expenses are. Okay. Um, the accounting equation, as you know, just on your balance sheet, your statement of financial position, assets are always equal to your liabilities plus your equity. That's what makes it a balance sheet. The two sides have to balance. We talked about the accounting cycle. Now I want to talk about the trial balance. Now they do have a picture of a trial balance here, and there's one also in your textbook that looks just like that. If you remember back in accounting 1 or accounting 2, I think everybody here took accounting 1 and accounting 2, we had account numbers attached to each category of assets. If you remember, or sorry, category of accounts, I'm jumping ahead. Assets, if you remember, started with a 1. So maybe cash was called 101. Accounts receivable may have been called 102 or 105. Um, then we had our liabilities, which started with a 2. Then we had our equity accounts, which started with a 3. Revenues started with a 4, so maybe your revenue or your sales was called 407, for example. Then we get into expenses, and expenses can start with either a 5 or a 6, generally. Um, and we always got in the habit on that trial balance to actually printing off the trial balance in numerical order according to the categories of numbers for the accounts. Okay, so your assets always came first, then your liabilities, equity, revenue, and expenses. Um, and usually in industry, that's how it's done as well. But for some reason, the textbook, especially in this trial balance for Warren Inc., December 31st, 2013, they have all of the accounts mixed up. It makes it very confusing. And again, it's not always like this. And if you're printing a trial balance off from an actual computerized system, it's going to come off in the order of how the accounts are numbered. Okay, so don't let this confuse you. I think the reason they're doing it this way is so that it's not obvious just by its order what the account is. So they're trying to get you to look at each account and figure out what statement it goes on. Okay. So for example, cash and cash equivalents is statement of financial position. And then we've got statement of income for income tax expense. Okay, so that's why they're doing it this way. So just have a look through, and again, it'll give you a good opportunity to be reminded of what accounts go on which statements. Accrued expenses, and actually I'm going to just do a couple more statements or a couple more slides, and then I'm going to cut this video off and then start another one. I try not to make my videos much longer than 10 minutes. So accrued expenses, that would be, if you remember, again, back in Accounting 1 and Accounting 2, where we always said that just because it hasn't been paid, it's still an expense. It's still because we operate not on a cash basis of accounting, but what's called the accrual basis. So therefore, we'd set up the liability. Okay, so even if you haven't paid your employees' wages yet, you would still have to claim them for the month, put them in as wages expense, and you would put it in as wages payable, for example, or if you haven't paid your phone bill for the month, it would still go under telephone expense, and the other side would be accounts payable. Okay, so what this is talking about for accrued expenses is Even if the bill hasn't come in the mail for your heating bill, for example, you still need to claim an amount for that expense because you did use it. So a lot of times setting up accrued expenses involves guesstimating how much. And a lot of times you can tell that by going back a year. So if this is for, say, November, then you'd go maybe back to last November and have a look and see how much you put in or how much your heating bill cost you. And that's a good way to guesstimate. Prepaid expenses, one of the biggest ones is insurance. It's not as much anymore where so many insurance companies allow everybody to pay their insurance on a monthly basis. Then it would just automatically be an expense when you actually pay that amount on a monthly basis. But if you have to pay your insurance a year ahead, or if you choose to so that you can avoid the administration costs, then it all gets set up in prepaid expenses and then gets expensed out on a monthly basis. Okay, I'm going to stop the video at this point and I will start part 2 of the video momentarily. Thank you.